Professor Namyong Lee's long commentary, The Yen Carry Trade Bomb, an invisible wave shaking the $1 exchange rate. Hello, this is Professor Namyong Lee's long commentary, The Yen Carry Trade Bomb, an invisible wave shaking the $1 exchange rate. Today, I would like to talk with you about the yen carry trade, a term that appears frequently in the news these days, but is surprisingly hard to explain in simple words. Japan's ultra-low interest rates, the higher interest rates of the United States and emerging economies, the dominance of the dollar migration of Korean households, the $1 exchange rate and even the Kospi are all connected within one gigantic web of relationships. In this commentary, we will calmly examine what the yen carry trade is, how it looks at home and abroad, how it affects the dollar and the $1 exchange rate, and how Japanese rate hikes shake the global economy. At the end, I will also pose topic-by-topic questions so that you can join the discussion in the comments. What is the yen carry trade? The name is unfamiliar, but the structure is simple. The yen carry trade is a specific form of a broader strategy called the carry trade that uses the Japanese yen. A carry trade means borrowing money in a currency with a very low interest rate and investing it in assets that yield higher interest, aiming to capture both the interest rate spread and potential exchange gains. Among these, the strategy of raising funds in Japanese yen and investing them in US dollar assets or emerging market assets is called the yen carry trade. For decades, Japan has maintained zero interest rate and even negative interest rate policies, so the yen has become one of the cheapest currencies to borrow in the world. Japanese households, financial institutions and pension funds, as well as global hedge funds and investment banks, have all come to borrow yen and buy US Treasuries, S&P 500 ETFs, emerging market bonds and stocks, and even high-risk assets such as Bitcoin. From a relational viewpoint, the yen carry trade is a gigantic financial pipeline connecting Japan as a low-interest rate country with the rest of the world where investors search for yield. I would like to ask you, the viewers, is today the first time you have heard the term yen carry trade, or have you known the term for some time but never really understood the structure behind it? Please feel free to share in the comments which side you are closer to. That will help us match the overall level of understanding. The end of Japan's ultra-low interest rate era, why is this a dangerous moment? The direct reason the yen carry trade has again become a potential powder keg for global finance is that the Bank of Japan has officially ended its negative interest rate policy and has started down the path toward normalizing rates. Even a small increase in rates means that the cost of yen funding, which was almost free, begins to rise. For investors who borrowed yen to buy dollar assets, this means that the net profit after deducting interest costs will gradually shrink. The problem is that such changes can unfold slowly and gently, but they can also erupt suddenly along with market fear. When the Bank of Japan hints at additional rate hikes, or when US inflation and employment figures come out differently from market expectations, markets can respond in an instant with a stronger yen, falling stock prices and surging bond yields. At such times, positions built up through the yen carry trade may be unwound all at once, creating large waves across global equity, bond and foreign exchange markets. Let me ask you a question. Which feels more frightening to you personally, a slowly rising interest rate or one that suddenly spikes? And do you feel that changes in Japan's interest rates actually affect your daily life and investments? If you share your sense of this in the comments, it will be very helpful. The hidden players behind the yen carry trade, Japanese households, pensions, and global capital. To grasp the weight of the yen carry trade, we need to see who is actually at the table. The first group is Japanese households and individual investors. For many years, they have learned to move away from ultra-low interest deposits into overseas bonds, funds, and high dividend stocks to capture the interest rate gap. Japanese insurance companies, securities firms, and banks have helped by channeling client funds into such products. The second group is Japanese pension funds and life insurance companies, which are long-term institutional investors. They hold enormous yen-denominated assets and have long managed portfolios mixing Japanese government bonds with overseas dollar assets over many years. Because even small changes in interest and exchange rates force them to readjust their asset allocation, they are among those who react most sensitively to shifts in Japanese monetary policy. The third group is global hedge funds and investment banks. They compare interest rates in Japan, the United States, and Europe, and calculate where they can borrow cheaply and where they can lend dear. Using low interest rate currencies such as the yen, they raise large-scale leverage and invest in emerging market bonds and stocks, high-yield corporate bonds, and various derivatives. When this money flows in one direction, markets dance. When it flows out in the other direction, it becomes a storm. Among these three groups, whom do you think has the greatest influence in the yen carry trade? Japanese households, Japanese pensions and insurers, or global hedge funds? Please share in the comments where you think our attention should be focused. Your thoughts will help shape future episodes of this commentary. The yen carry trade and dollar dominance, the invisible hand behind US asset markets. If we look at the yen carry trade from the dollar's perspective, a different picture appears. Yen borrowed in Japan is mostly converted into dollars and then flows into US treasuries, corporate bonds, S&P 500 ETFs, Nasdaq growth stocks, and various alternative assets. In this process, demand for dollars grows and the prices of US assets are supported. The yen carry trade links Japan's low interest rates, America's higher interest rates, and the dollar's status as the world's key currency into one long conduit. In normal times, this structure works to the advantage of the United States. The dollar finds it easier to remain strong, and capital from around the world flows into US. However, when Japan raises interest rates and the yen turns stronger, this conduit can begin to run in reverse. As investors who built positions using the yen carry trade cut back, money can flow out of US dollar assets, and both US stock and bond markets can be shaken. One of the hidden pillars supporting the dollar system begins to tilt. Do you feel that US stocks and dollar assets are now too expensive, or do you still see them as reliable, safe assets? It would be very helpful if those who do invest in US assets and those who do not could share their respective views in the comments. The yen carry trade and the $1 exchange rate, how it connects to Korea's dollar migration. Let us now come down to the situation in Korea. Many Korean households, pension funds, and institutional investors have already shifted a great deal of money from won-denominated assets to US stocks and dollar assets, following a kind of dollar migration. Rather than domestic stocks and real estate, capital has flowed strongly into US S&P 500 ETFs, US big tech names, and US bond ETFs. The point where the yen carry trade and Korea's dollar migration meet is the $1 exchange rate. The more active the yen carry trade is, the greater the global demand for borrowing or buying dollars is likely to be, making it easier for the dollar to remain strong. In that case, the $1 exchange rate tends to stay elevated or even rise further, and the value of Korean households' dollar assets becomes larger in won terms. Conversely, when Japan raises interest rates and yen carry positions shrink, the dollar's strength may weaken, but at the same time, risk-off sentiment can grow and foreign capital may leave Korean and other emerging market assets. The $1 exchange rate, the KOSPI, bonds and real estate could all be shaken together. For you personally, do you feel that your assets are more exposed to the won or to the dollar? And is your mind more at ease when the $1 exchange rate rises or when it falls? If you share your feelings and thoughts in the comments, they will be a valuable reference for others. Japanese rate hikes and the unwinding of the yen carry trade. 3 risk scenarios. Let us look more concretely at the possible unwinding of the yen carry trade under rising Japanese interest rates. The first scenario is a gradual adjustment. The Bank of Japan cautiously raises rates and the yen slowly strengthens over several years. In this case, yen carry positions can be reduced step by step. Markets may be shaken frequently, but the risk of a single catastrophic crash is relatively smaller. The second scenario is a sudden shock. Prices, wages, and politics become entangled, and the Bank of Japan raises rates faster and more forcefully than expected. Or markets may become frightened and move first merely on the possibility of such a move. At that point, hedge funds and institutional investors may race to cut their yen carry positions, causing stocks, bonds, cryptocurrencies, and exchange rates to swing violently all at once. The third scenario is that the Bank of Japan, worried about economic slowdown and political backlash, delays rate hikes as long as possible. In that case, the yen carry trade may last longer than expected, and markets may remain in a kind of intoxicated state for some time. But since interest rates and capital flows must eventually normalize, the time of the bomb may merely have been postponed, not removed. Which of these three scenarios feels more realistic to you? And in each case, what kind of preparations do you think Korean households, pension funds, and small and medium-sized enterprises should make? Please share your views in the comments. How nations and households should respond, searching for global best practices. The waves of the yen carry trade are far too large for individuals to bear alone. That is why the design of national-level safety nets is so important. Looking at global standards, we can see that advanced economies try to coordinate central bank monetary policy, finance ministry fiscal and foreign exchange policy, financial regulators' supervision, pension and deposit insurance operations within one overarching framework. This is a kind of macro-financial architecture. Differences between Japanese and US interest rates, the size of yen carry positions, dollar strength and weakness, the $1 exchange rate and foreign exchange reserves, and the soundness of banks and securities firms should not be managed separately but within a single design. Households and pension funds face a similar challenge. It is risky to cling only to one-denominated deposits and domestic assets, and it is also risky to tilt too heavily toward US stocks and dollar assets. The mix of won and dollar and of deposits, bonds and stocks should be designed from a long-term perspective according to one's life cycle, income structure, and risk tolerance. As the Japanese example shows, switching deposits only after interest rates have already turned is always one step behind. Decisions should not be driven by ignorance, incompetence, or greed, but by an understanding of relationships and data. What kind of information and policies would you like to see disclosed and explained more transparently at the national level? And what kind of help would you like this channel to provide so that individuals and households can better understand global capital flows such as the yen carry trade? I would be grateful if you could offer suggestions in the comments. Two hypothetical viewers, A and B, two different risk maps. Now let us draw the risks of the yen carry trade more concretely through two hypothetical viewers. Viewer A earns a salary in won and steadily buys US S and P 500 ETFs and US bond ETFs with spare cash. If Japanese interest rates rise and yen carry positions shrink, A's US assets may suffer a significant short-term correction. If the $1 exchange rate falls, A's exchange gains will also be reduced. However, if the US economy and corporate earnings remain solid over the long run, such correction phases may actually become good buying opportunities. The important point is to develop a habit of thinking about the directions of the yen carry trade and one's own investment plan together. Viewer B has most of his or her assets tied up in Korean real estate and won-denominated deposits and has almost no dollar assets. On the surface, B seems to have nothing to do with the yen carry trade. But if the unwinding of the yen carry trade accelerates and global capital leaves risk assets, foreign money may exit Korea as well, potentially leading to a weaker won, volatile interest rates, economic slowdown, and a cooling real estate market. B may feel the aftershocks of the yen carry trade not so much through direct financial losses as through changes in the real economy, employment, and rental markets. Which of these two situations is closer to your own? Are you more like A, with a high proportion of US assets, more like B, focused mainly on one-denominated assets, or somewhere in between with a relatively balanced mix? If you briefly share your position in the comments, it will help all of us understand each other's risk maps. Conclusion: completing today's yen carry trade map together in the comments. In this commentary, we have walked through the concept and global reality of the yen carry trade, its impact on the dollar and the $1 exchange rate, the shockwaves caused by Japanese rate hikes, and the appropriate responses of nations and households. I hope it has become a little clearer that the low interest rate policy of a single country can shake global capital flows, dollar dominance, the dollar migration of Korean households, and the fate of the won all at once. I do not see this commentary as a finished analysis that I deliver alone, but as a yen carry trade map that we complete together through your comments and experiences. In the fluctuations of the yen carry trade, Japanese interest rate hikes, and the $1 exchange rate, what worries you the most, and where do you see opportunities? In which direction do you think household savings, pension funds, companies, and national policy should move? If you share your diverse views in the comments, I will reflect your voices in the next commentary and push our discussion to a deeper level. Thank you for watching Professor Namyong Lee's long commentary.